Hello, welcome to Accounting Hub. I am Professor George Scarpin, PhD in accounting, and our topic today is equity, stock dividends, and stock split according to the USGAAP. So, guys, subscribe our channel, like our video, like our Facebook page, Accounting Hub by Dr. Scarpin. It is very important to us. What is stock dividends? Distribution of additional shares of stock to current shareholders of the corporation. So instead of paying dividends with cash, I pay dividends issuing new stocks or new shares. Affects neither the asset nor the liability. We will be working only with equity accounts, and shareholder proportional interest in the firm remains unchanged. We have small and large stock dividends. Small stock dividends, less than 25% of corporation issued shares. We do it uh, based on assumption that a small stock dividends will have little effect on market price. Large stock dividends greater than 85%. And so small stock dividends, we record it as at market value. Large stock dividends record at par value. And we have a special scenario for large uh, the large stock dividends, that is the stock split. Uh, when we do, for instance, 100% stock dividends could be labeled as 2-for-1 stock split and accounted for as such. So large stock dividends, we record it at par value. If we consider it stock split, we don't record it because it's no changes. So stock split, no journal entry, and account for the large stock dividends as stock split if effect in the form of stock dividends. Avoid the change to the record by recording an entry to change the balance in the stock amount. So here, let's see how it works. Let's go to our Excel file. Our Excel files, guys, they are free for all of our videos. And the link to download it is in our video description. Okay? So here we have 100 million shares. And first we declare and distribute 10% common stock dividends. So 10 million shares. When the market value of the $1 per share is $15 per share. So we debit retained earnings just like any other dividends. How much? 10 million shares times $15. $150 million. Credit, just like issuing any other share, any other stock. Common stock par value, 10 million times 1, and the paid in capital to balance, the 14 remaining. What if we work with large stock dividends, 100% stock dividends? So we will issue 100 additional shares. So work with par value. And we can do it in two different ways. The first one, only paid in capital excess of par and common stock. So here, 100 million, 100 million stocks times $1, 100 million common stock, additional 100 million. And why par value instead of market value? If we register here for the market value, uh, we will not be able to balance this journal entry here. Or our paid in capital would get a negative balance, or it would be kind of weird stuff here. Or just like this first journal entry, retained earnings 100 times $1 par value, and credit common stock 100 million dollars. That is the par value. So if we are working with par value, we have no paid in capital excess of par. Okay, guys, usually we have small stock dividends. Split dividends only when the price is so high that we split it in two or three or four. For instance, Alphabet Inc., that is Google, their shares, they are more than $1,000 for quite some time. So it would be a very good one to split it into shares of $500, for instance. Okay, guys, so thank you so much. Questions or comments, leave it here or email me at scarping@gmail.com. Have a very nice day and God bless you.